Okay, for this video, I'm going to cover the IRS Form 8858. This is a disclosure that goes along with a U.S. tax return when that U.S. person owns equity in a foreign disregarded entity. So I've got a sample 88 in front of us here, and then one slide with some of the background information on the form, what needs to be completed, and then the fact pattern that we'll be looking at when we go through the example. So what is the 8858? Again, it's generally included with a U.S. income tax return, right? So if you're a U.S. person and you're filing a 1040 as an individual or an 1120 as a corporation, partnerships shell out a 1065, or an S corp filing an 1120S. When that U.S. person owns stock, so equity, in a foreign entity, and that foreign entity is treated as a disregarded entity for federal tax purposes, or it's operating a foreign branch. Okay, so if you find yourself within that kind of fact pattern, you'll likely need an 8858 with your U.S. tax return. So the best way to look through this is with an example. So we have John here. He's a U.S. citizen, and he's living and working from Miami. Now, John decides that he wants to open a foreign corporation in Cayman rather than, let's say, go with a Florida corporate entity or a Delaware entity. And he's going with the Cayman Islands entity, and he's going to own 100% of the stock. And the reason he's going down this path is because he feels that the foreign corporate structure is going to provide him more liability protection, right? So the entity is beyond the scope or the reach of the U.S. courts, so perhaps there's a little more protection there if anything goes wrong. And that's partially true. Right. So, but now what are the tax issues? That's what we're focusing on here. Well, John talks with his tax advisor, and the tax advisor gives him, the good, the bad, and the ugly here. So when you have a U.S. person owning stock in a foreign corporation while you are running the company from the U.S., there's a bunch of issues you need to be aware of. So the first one is if the U.S. person owns 100% of the stock, that foreign corporation is going to be a CFC for federal tax purposes, right? So CFCs, controlled foreign corps, have a number of different disclosures, income inclusions, a bunch of issues, right? So when you have a CFC, the first thing we need to consider is, do we have any kind of subpart F income inclusions? Do we have any GILTI, that's global, intangible, low tax income inclusions? These are the anti-deferral mechanisms which say that, well, even though you've got a foreign corporate entity, if you've got U.S. shareholders in there, a lot of times that income is passed through to you anyway, even if you don't take any dividends. Now, from a disclosure perspective, the U.S. person needs to include the 5471 with their return, and it goes along with John's 1040 in this case. Now, the other issue here is because John is the sole shareholder and he's living and working from the U.S. for the entity, the CFC is going to be deemed to be engaged in a U.S. trade or business. And as a result of that, it's going to have U.S. source effectively connected income. And this is the standard when you have a foreign corporate entity that has a U.S. office. Right, so John is physically present in the U.S. when he's going to be working for this company. He's got a U.S. office, so there's no way around this U.S. trade or business or U.S. ECI issue. If the foreign corporation finds itself in that place, now in addition to all this, it's got to file a Form 1120F and pay U.S. corporate income taxes on its net taxable income. And then there's also BPT, or branch profits taxes, computations, and payments, if that does apply. Now, so John sees all this and says, well, this is a lot. Is there anything I can do to try to, slim down all these issues? And the answer is yeah. So what John can do is he can file an entity classification election for that foreign corporate entity, and make the entity a disregarded entity for federal tax purposes. So you need an EIN for the entity, file the 8832, and because he's the 100% owner, he can treat it as a foreign disregarded entity for federal tax purposes. Now, once that's approved, how does the profile change a bit? Well, now that it's a foreign DRE, it's no longer a CFC. So we're not dealing with subpart F or GILTI income issues anymore. We're not dealing with 5471 issues. Instead, we're filing an 8858, which is, again, the substance of this video, we're disclosing our U.S. ownership of a foreign disregarded entity. Now, because this is going to be a consulting business for John, he's going to have to report all of the income and expense on his Schedule C. And it's very similar reporting to if he owned 100% of a Delaware LLC, right? I mean, if you have 100% ownership of a U.S. single member LLC and it's a disregarded entity, everything is just reported directly on your return as the owner. The very similar reporting that we're going to look at here. He would file a Form 926 to show the transfer of cash and capital to the foreign entity in exchange for stock. And then again, like I said earlier, he's going to report all this income and expense on his Schedule C, and it's going to be recorded and subject to U.S. federal income taxes and self-employment taxes. Now, that piece right there would be inevitable anyway, for the most part, right? He could leave it as a CFC. And if he didn't have a U.S. trade or business, he would still have Subpart F or guilty. In this case, no, he would still have the 1120-F filing, he'd be paying corporate income taxes. So if you're looking at this last line item there and thinking, well, I'm paying U.S. federal income tax and self-employment tax, he was going to be paying tax anyway, right? First at the 1120-F level, because this is a foreign corporation engaged in U.S. trade or business. So you have corporate income tax, BPT. If he drew a salary from the company, he would have, those types of issues, reporting income for wages, potentially self-employment tax. So this pathway to complete the 8858, a little more simple from a reporting perspective, but yeah, at the end of the day, you're still paying tax. So let's look at the form and start working through some of the elements. So the 8858, again, it goes along with the U.S. return. So we got John's information up here. And then in this section here, we're indicating FDE, so a foreign disregarded entity of a U.S. person. If this was a branch, you would check this second box down here. And then if you're filing this in response to one of these scenarios, then obviously you would check that appropriate box. We've got an initial 8858 here. So name and address of the foreign disregarded entity. We've got John T. Consulting Limited. So this is a Cayman Islands entity. And the EIN for the entity. Again, this is going to have to be inputted there because you would not have been able to make the entity classification election without the EIN. So John had to apply for an EIN first, then make an entity classification election. And so now he's got the information here for the company. So it's a Cayman Islands Limited Company, which is by default treated as a foreign corporation. You have the date of organization, effective date that it became a foreign disregarded entity. So he made the election for it to be a DRE on the very first date of formation. Okay, country formation, Cayman, principal business activities and consulting, and then functional currency here is the U.S. dollar. Now Cayman does have its own local currency, but it's very common for companies that are formed there to operate their functional currency in U.S. dollars because it is the world's reserve currency. So you can get U.S. dollar bank accounts in Cayman, and so all their financial reporting is done in Cayman anyway. So then in part 2A here, enter John's name in the United States, right? I mean, he's the sole shareholder. He's the agent that's representing the company in the United States, so it's appropriate to put him down here. And then the remainder of this section would be completed if you had other individuals or entities that serve these roles that were different than John, right? So like, for example, in 3, it says, for the tax owner of the foreign disregarded entity, if different from the filer, provide this information. Obviously, John is the same person here, the tax owner, the direct owner, so we don't have to complete this extra information for him. Okay, so Schedule C, this is where you enter the income statement information for the company, and then later on we have the balance sheet as well. So John prepared a very simple set of financial statements for his company. So we have John T. Consulting Limited. He's got his revenue here, expenses, and then a balance sheet at year end. So there's cash accounts, accounts payable, and then the equity reconciliation. So take your financial statements, enter all of the details as appropriate in Schedule C. So you'll notice here that not a lot of details required, right? So he reports his gross receipts, and then total deductions is just lumped into one item, right? So we want a net income or loss per books value in the functional currency and then translated to US dollars. Again, in this case, it's one and the same. If your functional currency was something else, obviously you would have to translate it to USD using the appropriate rate. Okay, so Schedule C1, in this case, he doesn't have to file this. So if you have qualified business units for your entity, you might have to file this. But in this case, he doesn't, right? The financial statements are reported using the same functional currency as the US dollar. So in this case, this is just a moot section for John. Schedule F, balance sheet. Again, you'll notice very simple. You're just reporting assets, liabilities, and equity. They just want one line item totals, right? So nothing too complicated there, but nevertheless, you still got to report it. Schedule G has a bunch of questions. Just answer yes or no, depending upon whether it's applicable to your entity. So in John's case, 1 through 5 are all no. And then Schedule G continued on page 3 here, some additional questions that are no. And then when you get down to question 10A, right, so answer the remaining questions in G only if the tax owner is a U.S. corp, right? So if this was being filed with 1120, you would have to complete these additional questions, but in this case, John's an individual, so he doesn't have to complete the remainder of this section. Okay, so Schedule H, E&P. This is where you report, obviously, net income or loss per books, and then you have adjustments to E&P, depending on what is effectively going to be allowed as a deduction or an income inclusion under U.S. federal tax purposes. In this case, John's books are very, very simple, so we don't have any adjustments to E&P for U.S. tax purposes. Okay, and so Schedule I, again, answer, in this case, no, yes or no, depending on your circumstances. And then Schedule J, Cayman is nice in that it doesn't have any local corporate tax. So Schedule J is just blank for John's company, right? If you had a foreign disregarded entity in a country that had income tax, then you would likely complete Schedule J to report the country where you had those taxes imposed, the currency, the amount, the exchange rate, and so on. Okay, so that's the 8858 very simply. But now what I want to touch on is where this is also reported on Schedule C. So 8858 has to be completed if you have a foreign interest in a disregarded entity, but the same information, again, is going to be recorded on Schedule C for John, right? Because it's a disregarded entity. He's running the company, so it's going to be self-employment income to him. Again, very similar reporting to if John just had a 100% interest in, let's say, a Delaware LLC that was a disregarded LLC. All the information would be reported on Schedule C. So we've got John's Schedule C here, consulting, the business name, John T. Consulting Limited, right? He materially participated in the company. He started it this year. No 1099s were filed for the year, none that were necessary, that is. And then Part 1 and 2 completed like you would, again, a disregarded LLC, right? Same type of issues. So you have your income, the various type of expenses, right? Insurance, legal. And you'll notice here the profit or loss is the same as what was on the 8858, right? So $70,550 is his net income or loss per books. No book tax adjustments for John. Again, very simple financial statements. And then in Part 4, you have vehicle information doesn't apply. Part 5, more detail on the expenses. So this is where you would see more detail on the actual financial statements for the company rather than what's included on the 8858. And so, yeah, that covers it. So, and then again, this is an amount that's going to be flowed through up to his 1040. It's going to be subject to federal income tax. It's going to be subject to self-employment tax, and that's just the way it works. So, yeah, thank you for watching. I hope that was helpful. And if you have any questions, leave me a comment below. Thank you.